The market feels like a watermelon getting more and more rubber bands stretched around it. At some point it has to give, but I can't tell when. I'm Tony with Clarkson Santoro, and this is our real estate update for the week of Friday, June 13th. We know that buying or selling a home can be very stressful and confusing. That's why we do these weekly videos, so you can know how the market is affecting your options as a home seller or a home buyer. Like always, we will start off by looking at how the market performed this past week. Starting with active homes, there's still about 70 homes on the market, 71, which is a little bit less than we had last week. The average asking price is a little bit lower this week at $1,071,000, just under the $2,008,000 we had last week. 9 homes went pending this week, one less than last week. But the average asking price of those pending homes jumped significantly to $2,013,000, up from $1,664,000. One more home closed this week than last week. And again, the more important number here is the fact that the average closing price jumped significantly to $2,246,000, up from $1,824,000 last week. So now that we know how the market performed this past week, we like to look at the broader indicators and trends that help us try and determine where the market might be heading. Before I do that, if you do find this information helpful, you can hit the subscribe button down below so you don't miss out on future updates. And while you're at it, why not share this with a friend also? Everyone deserves to be in the know about their local real estate market. Okay, let's take a look at those trends. Starting, like always, with inventory. It has remained relatively flat for the past 2 months. We've seen it bounce between 65 to 75 homes throughout the week for the past 8 weeks, generally settling in the low 70s each Thursday. There's a positive spin to put on this higher inventory level. Typically, when we have a market that is moving this slowly, the inventory levels keep climbing. The fact that they have plateaued at about 70 is keeping the bottom from falling out on home values. Part of the reason inventory is continuing to climb is that pending sales numbers aren't nearly as anemic as they were a few months ago. I should say that's why inventory isn't continuing to climb. That has not translated to an increase in the turnover rate, but it has kept the turnover numbers from plummeting. Turnover rate is still hovering around 50% range, right here, which it's been at that for a while now. That's not great, but with the inventory at nearly double our normal inventory levels, the fact that the turnover rate isn't dropping is reassuring. The over-under numbers are finally starting to really be affected by the sluggish market. They landed in the under range for the first time in 3.5 months. Here was the last time they were down in the under range. To be frank, I'm surprised it took this long for the over-under numbers to get here. It shows the high desirability for San Ramon, that it took so long with sluggish turnover rates to fall into the under range. It is now more imperative for homeowners to set realistic prices for their homes and be ready for it to take a little longer than normal to sell their home. Home values continue to hold despite the slower market movement. This week, the 30-day average closing price jumped back up over the $2 million range, after it had dropped below that for the past couple of weeks. Or since, I should say, dropped below the $2 million range since the end of last quarter. This really doesn't indicate an increase in the value of average homes or a decrease in the average price of a home. In a slow market like we are experiencing now, the average can swing quickly due to small sample sizes. So this average price tells me that a few higher priced homes finally closed, as opposed to the past several weeks where the 1.7 to 1.9 range prices were selling. The one thing that continues to push up against the downward pressure on the other market trends is the strength of the stock market. Despite inventory climbing and pending sales lagging, we still have an influx of well-qualified buyers interested in this area. The Triple Q Fund continues to perform well. After it took that dip back in April, it has continued to rebound and climb higher than it had been before the big dip. So the majority of our home buyers have plenty of cash available to purchase the home they like. That is the one thing that keeps those homes that do go pending quickly from struggling on price. We remain in a market where the very highly desirable homes are still getting interest quickly and from multiple buyers. That qualification of highly desirable seems to be narrowing though. Despite the stock market creating positive upward momentum, the interest rates continue to do their level best to hold downward pressure on the market. Oops. Okay. They remained in the high 6% range this week, making it more than a month and a half since the national average was below 6.8. This remains the single most significant indicator for our market. As long as these rates stay up, the market is going to remain sluggish. If and when they come down to the 5% range or lower, I think that will open a floodgate of both buyers and sellers joining the market again. The big unknown is when. This year, the market has felt like a watermelon that is slowly having rubber bands placed on it one at a time. If you've ever seen a video of someone doing that, or put rubber bands on a watermelon yourself, I think you can picture that tension. At first, it seems completely harmless and like nothing will happen to the watermelon. Soon enough, you'll start to see the watermelon kind of deform and start making ominous creaking and cracking noises, and you can watch the people's faces as they're putting it on each new rubber band. It's like, oh my goodness. But even that can take a while before the watermelon violently explodes. In that last 20 to 30 rubber bands, you kind of flinch every time because you're certain this will be the rubber band that finally ruptures the watermelon. But it can still take way more pressure than you realize. I know, kind of a weird analogy, but that's just the way my brain works. Comparing the market to the watermelon, I think interest rates are like the watermelon rind, holding the market down and keeping it from exploding and going nuts. Meanwhile, the economy and the stock market are those rubber bands putting more and more pressure on that the watermelon market. If the economy continues to improve and inflation slows down, there are less and less reasons for the Feds to hold off reducing rates, and I think eventually the high interest rate rind will crack, and when it does, the market is going to explode. But watermelon rinds are thick and resilient. Every time it feels like it's about to blow, you take cover and then it settles down. Until finally, kablooey. The big question still is, when is that going to happen? Thanks for joining me for this weekly update. I hope the watermelon talk helps you understand how our market is impacting your options. Don't forget to hit the subscribe button down below and ring the notification bell so you can stay informed on how the market is continuing to shape up as we head into summer. And if you have any specific questions about how you can navigate the stressful and confusing process of selling or buying a home, leave a comment down below or reach out to us directly. Our contact information is down in the comment section also. We're here to help guide you every step of the way. Have a safe weekend, and for all the dads out there, happy Father's Day, and I'll see you next week with a new update.